Hello, hello. First, I'm gonna look at the S&P. So this Friday, the S&P was up 1.6%. However, in the week, it was down 1.2%. It was down a lot. We're in a pullback here in the stock market, and the NASDAQ. Let me see how much the NASDAQ was down this past week. Down over 3% in the past week. So there's some opportunity here potentially to buy. So I'm going to go over what companies I bought this week. So the first company I bought was Arista Network. Let me put this in here. Arista Networks. As we can see here with Arista Networks, this company basically makes like large data centers for the huge companies like Microsoft and basically provides all the computer hardware for them. And as we can see here, the PE ratio is positive, which means they are profitable. However, it is pretty high. I still bought it with this high valuation because I think they can continue this growth pretty good. Forward PE ratio of 36.9. Normally, I want that less than 30. However, doing the intrinsic value calculator, you can see that I think it's at a pretty good price right here. And I also want to pay a lot more for great earnings. Profit margin of 40%, very high profit margin. Look at how much cash they have compared to debt. $8.3 billion in cash while they only have $59 million in debt. Normally, we want this total debt to equity less than 50%, and it's at 0.6%, which means they're very unlikely to go bankrupt here. Now let's go and look at the revenue. Right here, look at this revenue growth. It's just very consistent besides 2020, but look at this. Consistently growing at 20+% until basically now it is slightly slowing, but it's still very good. Let's look at the EPS. EPS growth rate, very good. 50% about. It's just very fast growing company. Shares outstanding aren't what I love to see. However, it's pretty stagnant right here. It's pretty stagnant over the past 5 years, so that's pretty good. At least they're not diluting us shareholders, so let's look at what their expected EPS growth rate is. If we go over here, detailed earnings estimates, scroll down, they're expected to grow at about a 14% rate over the next 5 years. The past 5 years, they were growing at a 32% rate. So this is a fast-growing company, very fast-growing. If we go over to the intrinsic value calculator, put in Arista Networks. So they're expected to grow about 14%. So I'm going to put that at 14. Net profit margin, I'm going to put this at 40%. And then terminal PE ratio, I'm going to put this at 25 just because of the fast growth. And I see if you bought this today, you would make about 11.5%. So right now I have a very small position I'm going to build up over time. Dollar cost average hopefully down more so I can have a lower cost average. And let's look at the next company that I bought this week. And probably one of my favorite companies that nobody talks about, and it's Fabrinet. It's called Fabrinet. This company basically makes a bunch of products. They make lasers for a bunch of automotive stuff. They make sensors and all that good stuff. They make a large variety of products. So let's first look at the PE ratio of Fabrinet. Trailing PE ratio of 22.38. They do not have a forward PE ratio, probably because it's such a small company that analysts aren't even covering it really. So, but it is a good, pretty reasonable PE ratio. And if we go and to look at, that's very good. But if we also very similar between Arista Networks and this, they have such a low total debt to equity ratio. Look at the cash compared to their debt. They have $934 million in cash and only $6 million in debt. So that is very good. A 0.3% total debt to equity ratio. Very unlikely for them to go bankrupt unless somehow they do something insane. Here, if we look at this, 106.32% held by institutions. I don't even know how that's possible, but that shows me that the institutions do like this company. Held by insiders, only 0.7%. A lot of a lot of shorts on this company. About 7.8% of the float is shorting. So that's not very good, but I don't really care about that for long term. If we go over, let's look at the revenue. As you can see, revenue very, very steady, pretty much increasing every year, about 10 to 20%. Look at the net income. Once again, very good growth. Just very good growth overall for Fabrinet. And the shares outstanding, also like Arista Networks, basically steady. It actually is decreasing slightly, but barely. It doesn't, basically nothing. But now let's see how much they're expected to grow. Let's see what analysts expect them to grow at. They do not have any expectations because it is such a small company that analysts aren't even covering this. And it's not even based in the United States. So most analysts aren't going to be covering this company. But I do think this could be a very good multi-bagger company that nobody's talking about. Now, if we go here, I'm gonna be conservative here. I'm gonna give this a 10% revenue growth. Because look at the past 10 years. It's basically consistently growing at about a 15% rate. Let's go net profit margin. I'm going to put this at 10% net profit margin right there. Because it's growing actually very consistently. Since 2015, it's been increasing every single year. Cash conversion rate, we leave there. I'm going to put the terminal PE ratio at about, I'm going to say 22. And then put discount rate of 15%. As we can see here, while it's not exactly where we want it, if since I invested this at around $200 per share, I bought this I've been dollar cost averaging when I bought it, it was at $220, but it's been decreasing. It decreased very fast over the past week with the market. So I have dollar cost average down to like $208 per share, I think. So if you bought it here today, I think you'd make about a 14% rate. And this is being pretty conservative. Pretty low terminal PE ratio, low revenue growth assumptions, and a high discount rate. I don't see you going wrong investing in this company. Now, the next company I did buy this week is Hims and Hers. I have had this on my watch list for a long time. I actually did own this at about $6 per share, I think. I owned a few and then sold it right after. Big mistake. It's at 40 now. I bought this at $40 right after their earnings. This company is basically a telehealth company that provides prescriptions to people. And as we can see here, trailing PE ratio is very high at 85. Forward PE ratio 75.76, which is also very high. But I still think this is still a valuable company just because of the very fast growth of it. Profit margin only 8%, but as we can see with this company, if we go over as we can see the revenue here, very good increasing revenue, but if we look at the earnings per share, we can see they only just got profitable. They have been basically increasing every year, but right now they just got very profitable and have hopefully can stay profitable. Shares outstanding, this is the one thing I don't like about the company. They're increasing their shares a lot, but however, I think this could be a good thing because they're going to be generating a lot of cash from the company stock rising a lot. I think just because of them selling isn't the worst thing if they can raise enough capital. So I think they're going to raise a good amount of capital from selling after the stock is up like 500%. So it might not be terrible that they did sell. If we look at the earnings estimates for HIMS, they're expected to grow at a 57% rate. I think that is crazy high if I'm being honest. But let's go to the intrinsic value calculator, put in Hims and Hers, and let's see what I think the fair value for Hims and Hers should be. So they expected them to grow at about a 50% rate with their earnings, but this is revenue growth. So I'm going to put this to be conservative at 25%. Let me look up a calculator to see how much revenue that would be in 10 years to see if this is pretty reasonable. So if they're going to grow at a 25% rate, I'm going to put 1.25 to the 10th power since that's how many years. 9.3. Let's see how much their revenue was. How much was their revenue? Let me go over here. Their revenue was $1.24 billion. So if we multiply this by 1.24, we're going to get $11.5 billion in 10 years. And I think that's actually very reasonable for this company to go at. So I'm gonna leave this at 25. I'm gonna put net profit margin at 15%. And the reason for this is in their recent earnings, they did say that their net profit margin for the next year will be about 12 to 13. But since they're gonna be growing this company faster, I think 15 is pretty reasonable. And I honestly think this could be a lot higher than 15 in the future. Terminal PE ratio, I'm gonna put this at 20. I'm gonna put this at 20. The reason I'm not going to have this as high as normal is because I think there's a lot of competition in this space. So I'm going to put this at 20. And as we can see, discount rate 15%. The fair value price I have for Hims and Hers is $58.24. So if you bought this today at $45, I think you can make about an 18% return year over year if you believe these assumptions. So yeah. So if any of you guys in the chat want to tell me any more stocks to look at, I'll gladly look at. But I'm going to go over the last stock I bought this week. And this is Block. Most of you probably know Block. They own Cash App and let me see if I can find this. They own Cash App and Square. So it's a pretty big company. But if we go and look at the stock, let me go and look at the stock right here. Let's see. Over the past, if we look over its entire lifetime of the stock, you can see it was in the time of big hype stocks just going crazy, and it was at $270 per share. Now it's down 77% from that. So I think this is a good opportunity for us to buy. And if we go ahead and look at this, let's go to the statistics. Look at the trailing PE ratio here. It's trading very low at a 14 trailing PE ratio and a forward PE ratio also at 14. So this looks very good. However, the forward PE ratio being so close to the trailing PE ratio is a little bit worrying to me just because the forward PE ratio is basically the next year's earnings per share. So that means they're expecting basically 0% growth over the next year. So this is probably why the stock hasn't been moving much. 12% profit margin, total cash 8.57 billion, and total debt 7.92 billion. Total debt to equity ratio less than 50%, what we want. It's at 37.29%. So this looks very good just because of the total cash. They have more cash than debt. Basically, they could just pay this off right now if they wanted to. So it looks pretty good on that aspect. And 72% held by institutions, very high there. Now if we go over to the revenue, you can see it's been increasing basically every year. And this is why the stock was probably super high during this time. Look at this insane growth all of a sudden in the revenue, up 200%. 200% revenue growth during this time. That's probably why the stock went up so high. They probably during that time they probably expected this company to continue to grow at that pace, but as you can see, had disappointing revenue growth in the disappointing revenue growth in the next year. So that's probably why the stock tanked after that. And it's been growing still pretty decently, about double digits besides the past quarter. So looks pretty good. It's probably slowing down, but not a big worry, especially if you buy it at such a great price. Let's look at the earnings per share real quick. Earnings per share, once again, probably why it had such a large spike in price during 2021, because they were actually profitable here and then started losing money again. And now they're back to making money. So hopefully they can continue to grow at this rate. But if not, I don't know. It might not look good. But I think if they continue to grow, it's a pretty good price to buy. I personally think so. So let's look at the shares outstanding for Block. This is the one thing I really dislike about this company. I don't know why they are not why aren't they buying back shares when the stock price has not moved in the past like 2 or 3 years. It has basically been stagnant in this area for the past 3 years, and it's at a very low valuation. I think you should be buying back shares if I were Block, but yeah. Let's see what analysts expect. They expect them to grow at a 26% earnings per share rate. That is crazy fast. If let's go and look at our intrinsic value calculator. Let's go to the earnings growth because I want to put in what the analysts expect. If they really expect, how much was that? 26%. If this actually happens and they have, say, a terminal PE ratio of like 16, assuming this actually happens, you could literally make 35% every year if you bought this today. I think that is insanely overestimating their growth though. For the revenue growth, I'm gonna say 6%, net profit margin 12%, and then terminal PE ratio at 18. And since that's about where it's been, I think if you bought this today, you'd make about a 15% return. So that's why I bought these stocks in the past week. So yeah. If you guys have anything to say, please put it in the chat and I'll look at that company and decide whether or not it's a good company to look at to potentially buy. So yeah, put that in the comments. And if we look over here, let me see. Let's look at some of the bigger companies. Like let's look at Apple. Me personally, I'm not I don't think Apple is a very good stock to buy. I know that might seem a little crazy, but I do think it is very overvalued right now for a company that's not even going to grow very fast in the future. While it does have a very big moat, which there's not very big competitors and they do have a great ecosystem, I just don't think it's worth this valuation. If we look at the statistics, they're trading at a 38 PE ratio. Very high, 32.89 forward PE ratio. Let's look at the total cash. They have 53 billion in cash, total debt 96.8 billion. I did not realize Apple had such a big amount of debt, such a large amount of debt. Total debt to equity ratio 145%. Very high total debt to equity ratio. I don't know, Apple, I just don't like the company much. Not necessarily that I don't like the company, just the financials don't look amazing, especially as of lately. But obviously, if it got to a price that I would want to buy, then I would buy it. And we'll figure that out. But let's look at the revenue growth here. Since 2021, it has not even grown like at all. It's basically grown at a few billion. It's very stagnant. I would really need to see this company, Apple, start to grow more. Like it's very stagnant. It's very worrisome to me to invest in. The one thing that's good about Apple is their share buybacks. Look at these buybacks, guys. Over 6%, over 6% buybacks. This is insane. From 26 billion shares outstanding to 15 billion. That's basically about, if I do the math, let me go do the math here. That should be about like a 30 some percent. Let me see. How much was that? 26 went from 26 billion down to 15 billion. Okay. So that was about a 42% decrease. So let's just make it easier to understand and say that's about they have their shares outstanding. So if you had, say, 10 shares back in 2012, compare it to now, it's basically saying you'd have 20 shares now since you own more of the company. You will own double the amount of company from you not doing anything and just them buying back shares. So that's why we like share buybacks and not them diluting. So that's very good to see. Let's go and look at what analysts expect them to grow at. Let's go over detailed earnings estimates. Over the next 5 years, they're expected to grow at a 13.8% rate. That's pretty high. I'm surprised it's that much, but that is the earnings. Let's look up the revenue. Let's look up Apple revenue expected growth rate. 6% over the next 3 to 5 years. So let's put that into intrinsic value calculator. Put that 6% net profit margin. Been pretty steady at about 25%. So I'm gonna put that at 25. Terminal PE ratio. This is the tough one. I'm gonna put this at 25. And the reason I'm putting this at 25 is because I think Apple has a huge moat. So I think they deserve the premium. And for us about the market, I think the fair value for Apple is about $160 per share. So I really don't see why anybody would buy Apple right here, but that's just me. If we look at the discounted calculator for earnings growth instead, where they're expected to grow at about a 14% rate, with this, you can see that it's actually pretty. I think the fair value would be about $205. So if you do in between 110 and 210, I think the fair value is 160. I think I would buy Apple at $160 per share. That would be my target to buy Apple stock. So yeah. Now let's go ahead. Let's see. Any more stocks I bought this week? I don't think so, but I am looking. Let's see what companies I'm looking at. I have a watch list here. I'm looking at these companies. Let's see a company that probably nobody has ever heard of, but I have been looking into some companies here. Let me see if I can find this. Where did I put this? So I'm going to look at this company here. It's called Westinghouse Air Brake Technologies Corporation. They basically make brakes and stuff for railroads and railways, and they offer services for railroad companies. I do like this company pretty nicely, but the PE ratio for this type of company is pretty high to me. 30 PE ratio with a 23 forward PE ratio, I think is pretty high. But if we do, let's see the financials, because I don't think this will have it on here. So I'm gonna go total revenue. It's gone from 7 to 10 billion, so pretty decent growth in the past. It's not amazing growth, but it's decent. Net income, where's the net income? Here it is. Almost doubled in the past 5 years. So that's actually pretty fast for their earnings. So their profit margin must be increasing at a decent rate. They are buying back shares pretty nicely. They do have some debt, but not a crazy amount of debt. Free cash flow also growing pretty decently. Let's go. Let's go and look up this company in the intrinsic value calculator. Westinghouse Air Brake Technologies. So as we can see, let's go to the revenue. It's been growing about a 10 to 13%. So I'm gonna put this at 8%. I'm gonna put this revenue growth at 8%, net profit margin 10%, I'd say. Terminal PE ratio, I'm gonna put this at 23. I think the fair value for this company, well, not the fair value, but where I would start buying this would be about 115. If we want to see the fair value, I think is about $167. If you want to make about 10% on this company, I think $167 would be the right area to buy this. So yeah, guys, thank you guys for watching this live stream. I'm probably going to keep doing this for, I don't know. I'm going to try and do this every Sunday and ask you guys what companies you want me to analyze. So thank you guys for watching this. See ya.